Asset manager is any firm that manages money for third parties. While that's a broad definition, we can generally classify investment managers into two categories: hedge funds and long-only investment managers. We can take a look at some of the differences between the two groups in a moment, but first, let's take a look at how they're similar. They will take money from third-party investors with the hope of creating excess returns over some given floor or benchmark. The managers earn a fee for managing the portfolio and provide updates to investors on their performance, and also provide some insight into the portfolio holdings. Another similarity between the two groups is the structure of the management team. The structure of the management team is similar in that they typically have one individual, a portfolio manager, who's responsible for the overall management of the portfolio. This person or persons, and it's typically more than one person for some larger funds, will ultimately decide what investments get put in the portfolio. Depending on the size of the fund, the individual management team may be large or small, but they generally follow the same structure. Very large funds may have 2 PMs or co-PMs, and the firms could have anywhere between 2 or 6 or more analysts working on the team. Smaller firms may have 1 PM and 2 analysts, and very small firms may just have one individual responsible for the entire fund. So in this case, the PM would also be the investment analyst and will not only manage the fund, but could also do the portfolio trading and research individual stocks. Ultimately, the PM is responsible and has the final say on what makes it into the portfolio and therefore the returns of the portfolio. The analyst is responsible for doing more detailed work on individual stocks to determine if they would be a worthwhile investment. The funds themselves can have different focuses, so perhaps a fund will focus only on a single sector, such as technology, consumer discretionary, or energy, and some funds are generalist, and they can invest in any sector they like. All this information will be disclosed to investors up front, and those that try to concentrate on a particular sector typically have more industry expertise in that one sector. And generalist funds can invest in stocks and may be able to rotate into or overweight sectors they believe will outperform.
Most large institutional investors in the United States are required to publish details about their holdings in a 13F SEC filing. Bloomberg's FLNG Go tool lets you analyze changes in asset allocations reflected in the 13F at either a firm level or aggregated at a national level. Let's take a look at the current report. To do this, we'll select Aggregated Filings, Current 13F Report, Q2 2021. Now it's time to practice using the FLNG function. To complete this practice exercise, you will need to look at market value for 2 investor types. The institution menu allows you to show only holdings of a specific type. To complete this practice exercise, use the institution menu to look at hedge fund managers and investment advisors. For Q2 2021, what % of total market value invested do hedge funds represent versus traditional investment advisors? Click on the menu to examine each investor type. Click Answer when you are ready to answer the question. Correct. When you divide the market value for hedge fund managers, 2.4 trillion, by the market value for investment advisors, 30.7 trillion, hedge funds represent 7.81% of total market value. Click Continue to move on.
So those are the ways in which investment managers and hedge funds are similar, but there are many differences between the two types, and we're going to take a look at those now. The first is who invests in those two types of funds. Looking at hedge funds, they are typically have large minimum dollar amount requirements, which could be in the $5 to $20 million range to invest in the fund. So overall, the people who invest in hedge funds are high net worth investors or pension funds, large family offices, those types of investors. Minimum dollar amounts for investment managers is much smaller and could be as little as $50 to $100. These types of funds are more suited towards retail investors, and many 401ks have the option to invest in these types of funds. The ability to take money out of a fund typically differs between these two groups as well. Hedge funds have restrictions, sometimes known as gates, in when and how often you can withdraw money from the fund. Timing can vary depending on the fund, as well as the amount that can be taken out at any one time, but it will typically take between 1 quarter to a year to be able to actually get your money out of the fund after you provide notification that you want to withdraw money. This may be justified because, as you will see in a minute, some of these large funds are not investing in liquid securities, so it may take time to unwind some of their trades and to actually get the cash to investors. Investment managers, on the other hand, you can notify them at any given day or simply trade your shares in the open market of that given fund, and you'll be able to get your money after the trade clears. Fee structure is also very different between groups. Hedge funds typically have 2 levels of fees, one on the overall amount of assets at the firm. This is typically 2%, although as we'll discuss in a moment, overall fees have been declining over the past number of years. And hedge funds will also charge a fee on any profit, also known as a performance fee. So if a fund has $10 billion and that fund makes 10%, they'll have $1 billion profit. Of that profit, they will keep 20% or $200 million. The management fee and the performance fee are used to run the fund, so that can include renting office space, paying managers, anything to run the fund. The lingo for hedge fund fees is typically you put the two together. So if you hear 2 and 20, this is what they're referring to: the overall firm fee and then the fee charged for any profit. These are just averages, so funds can charge different rates. It could be 1 in 35 or 1 in 15. The structure is typically the same, but the amounts can differ depending on what fund you're dealing with. As with anything else, the funds with better performance will charge higher fees. Investment management firms only charge an overall fee to manage the fund, and that is typically in the range of 50 basis points to 1.5% of the total assets under management. Investment managers do not take performance fees based on the profits they make. There's just a single overall fee on assets. One thing to note is fees for asset managers have been declining recently. Given what some would consider lackluster returns, many fees they are charging have declined. Performance is one reason for this, and the shift towards passive funds is another. Recently, it has been estimated that 50% of the investing today is in passive funds. Passive funds do not try and outperform the market. They simply invest in a stated index, and they would just replicate that index. The fees associated with passive funds are much smaller, somewhere between 3 to 15 basis points. So they are obviously much lower than an active manager. Given some underwhelming performance recently with active funds and some hedge funds, investors are not willing to pay large management fees, and many have moved towards passive funds. We'll have to see if this trend continues, but it has been happening for the past several years. We can also compare these two groups directionally. Hedge funds will typically take bets or make bets long and short. So directionally, they can invest any way they want. If they believe a stock is going to increase, they can go long with that stock in the hopes it will rise. Alternatively, if they think a stock will drop, then they can short it and make money betting against the stock. Investment managers will almost always be only able to go long or to buy the stocks, meaning they can't short the market. So even if they felt the market was going to crash and go down significantly, they would still have to be long stocks. What makes this a little more complicated is most investment managers also have to be fully invested, so normally they cannot hold excessive cash levels. Typically, this range is they can only hold cash less than 5%. So an investment manager is more limited in the sense that they can really only do, as long as their mandate allows for it, is to move in and out of sectors and overweight sectors that they think will outperform. As a side note, some long-only funds can use, to a limited extent, index puts to try and provide some hedge against a market drop. This, in many instances, can only be on an overall index such as the S&P and a limited amount of the overall portfolio. Regardless, most investment managers generally only go long stock. Looking at absolute versus relative returns is another difference between the two groups. Hedge funds typically do not measure themselves against an equity benchmark. They typically hedge most of their books, so the real job is to make money in up and down markets. Because they have the flexibility to be long and short, the market, as discussed previously, they should be able to make money regardless of the direction the market is going. Therefore, they typically do not have an equity benchmark, but many have some type of benchmark rate of return, like a 2-year treasury rates, which they should always beat. So if a hedge fund cannot beat a treasury rate, then they probably shouldn't be investing at all. And investment managers will always have a benchmark. The benchmark should match the type of securities they are investing in. So a U.S. manager may have the S&P as their benchmark. They are always trying to beat this benchmark, and as well they should, because they're charging higher fees, so they should be able to provide value. As long as the investment manager can beat the benchmark, they will be considered to be outperforming and doing a good job. This is true when the market goes up, but it's also true when the market goes down. What I mean by this is if the S&P, i.e. the benchmark, declines 12% and the investment manager or their fund only declines by 4%, then this would be seen as outperformance and that they're doing a good job, even though the fund lost money. Complexity of the assets they invest in. Here, hedge funds can essentially invest in any type of security. This could be derivatives, options, swaps, really anything they want. Because they can invest in more complex instruments, some of these instruments may take time to liquidate and sell. This is another reason why it might take longer for any investor to get money out of the fund, because the hedge fund wants to protect against forced liquidation of some of these potentially complex securities they may be invested in.
In this practice exercise, you will have a chance to practice using HFA Go, Bloomberg's historic fund analysis page. HFA Go allows you to analyze historical risk and performance of a fund or portfolio so you can identify funds that meet your criteria and analyze portfolios of interest. The function is displaying the actively managed fund, Eaton Vance Tax Managed Global Diversified Equity Income. Imagine that your boss is asking what percentage of the time the fund has outperformed its benchmark index and what the longest winning streak was on an absolute return basis. Click on the tabs to find the answer. Click Answer to submit your response. Performed its benchmark index 51.26% of the time. Its longest. Imagine that your boss is correct. In the Performance tab, you can see that the fund has outperformed its benchmark index 51.26% of the time. Its longest winning streak on an absolute return basis is 6. Click Continue to move on.
Another distinguishing feature between hedge funds and investment managers is the amount of leverage they can use at the fund. Hedge funds will typically use leverage, meaning they borrow money from a broker or a bank against the cash they have in the fund. They take this additional money and try and invest it in stocks that they hope will get better returns than the rate they have borrowed the money from the bank. This will create more profit for the fund, but as leverage helps, when things go wrong, it can also be dangerous if the fund loses money and they lose money quickly. In this case, the bank or the broker may want the money back if the collateral against that loan, i.e. the stocks they are investing in, falls in value. This will force the hedge fund to sell some of their assets at unfavorable prices and will amplify their losses. This was highlighted in early 2021 when a very large hedge fund was forced to sell more than $20 billion in assets to meet some of these margin calls. Investment managers do not use leverage in their funds and will only invest the capital they receive from investors. Finally, disclosure of investments. Hedge funds typically do not disclose a clear picture of the investments they are investing in to the public. They typically file what is known as a 13F, which discloses their position at the end of a quarter, but it will only be a snapshot in time and only requires them, at least in the U.S., to disclose their long positions. No shorts and no derivatives. So you will not get a completely clear picture of what they're holding. Not to mention the fact that the day after they publish this information, they can change some or all the positions that they hold. Investment managers will disclose more information, typically monthly, in a portfolio update to their shareholders. This will disclose their top 10 or 20 holdings, the sector allocation, and the amount they hold in cash. Access to this is also easier to get as these reports are normally posted on the fund's website. We touched on this earlier, but investment managers can also be categorized broadly into two groups, active and passive managers. An active manager will try to actively beat and tactically pick stocks or overweight, underweight sectors to beat the benchmark. These managers believe they can outperform the market. Passive managers, as we mentioned previously, will just invest and replicate any individual index. We have a number of tools on the terminal that relate to hedge funds and mutual funds. Type the name in the command line and it should appear along with its ticker, and then you can select it. For hedge funds, we have HFND Go, which is the homepage for our hedge fund tools. Please keep in mind that to gain access to our database, you'll need to fill out a form saying you're an accredited investor. There's actually 2 forms you need to fill out before you can get access to our database. HFGo is a list of hedge fund indices that we have on the terminal. They're all tickerized, so you can look at charts of them historically, and they're also grouped into various categories such as credit hedge, equity hedge, and there's other subtypes in each one of these groups, as equity long short or equity hedge as examples. Finally, you can also screen for hedge funds at HFS Go on the terminal. This will allow you to filter our hedge fund database by type, style, geographic focus, as well as other filters. Once you do that, you will get a list of individual funds which you can click on and get more information on each individual fund. Investment managers, just like hedge funds, you can find simply by typing the fund you want to see on the terminal command line and then select the ticker from the drop-down. You can also search and filter for funds with our fund screening tool, which can be found at FSRC Go on the terminal. Here you can filter for many different attributes such as asset size of the fund, manager location, Sharpe ratio, and many, many more filters. Whatever you want to focus on, you can just type into the amber box and find the funds that you're searching for.